In this section, we will discuss the impact of Swiss listings on the financial performance of Chinese stocks, such as diversifying revenue sources, enhancing global branding, attracting foreign investors, but also facing competition and regulation. Switzerland has become a new listing destination for Chinese companies after China expanded a Stock Connect scheme late last year. The scheme allows Chinese companies listed on the mainland China A-share market to raise capital overseas by issuing Global Depositary Receipts (GDR) on the SIX Swiss exchange. The GDRs are securities that represent ownership of shares in a foreign company and can be traded on another country's stock exchange. So far, 4 Chinese companies have issued GDRs in Switzerland, raising about $1.5 billion in July. They are Sany Heavy Industry, GOT Ion High Tech, Keita Industrial Group and Ningbo Shanshan. They operate in new energy or manufacturing industries. More than 10 Chinese-listed companies plan to offer shares in Switzerland as a result of the new Stock Connect program. What are the benefits of Swiss listings for Chinese companies? One of the main advantages is that they can diversify their revenue sources and reduce their reliance on the domestic market. Switzerland is a major financial center in Europe and has a stable and mature capital market. By listing in Switzerland, Chinese companies can access a large pool of funds from European investors and expand their business opportunities in the region. Another benefit is that they can enhance their global branding and reputation. Switzerland is known for its high standards of quality, innovation, and governance. By listing in Switzerland, Chinese companies can demonstrate their compliance with international norms and regulations and improve their credibility and trustworthiness among global customers and partners. A third benefit is that they can attract foreign investors who are interested in China's growth potential but are wary of the risks and uncertainties of investing directly in China. By issuing GDRs, Chinese companies can offer a convenient and transparent way for foreign investors to gain exposure to their shares without having to deal with currency conversion, capital controls, or legal differences. However, Swiss listings also come with some challenges and risks for Chinese companies. One of them is that they have to face more competition and regulation from both local and international players. Switzerland is home to many well-established and influential companies in various sectors, such as banking, pharmaceuticals, engineering, and consumer goods. By listing in Switzerland, Chinese companies have to compete with these giants for market share and investor attention. Another challenge is that they have to comply with the rules and standards of both the Swiss and the Chinese regulators. This means they have to meet the disclosure requirements, audit procedures, and corporate governance practices of both markets. They also have to deal with potential conflicts or inconsistencies between the two regulatory regimes, especially in areas such as data privacy, national security, and cross-border transactions. In conclusion, Swiss listings can have a significant impact on the financial performance of Chinese stocks. They can provide them with more sources of funding, more opportunities for growth, and more recognition from global stakeholders. But they also require them to adapt to a different market environment and cope with more regulatory scrutiny and pressure.